Welcome to the Manhattan Institute's event cast. My name is James R. Copland, and I am a senior fellow with and director of legal policy for the Manhattan Institute for Policy Research. It's my pleasure to welcome you here today, and my pleasure to bring along Professor Paul Rose of Ohio State University. Professor Rose is the Robert J. Watkins, Procter & Gamble Professor of Law at The Ohio State University, Moritz College of Law. And we have recently published at the Manhattan Institute a report by Professor Rose on what's called robovoting and institutional investors, how they robovote with proxy advisory firms. So welcome, Professor Rose. I'd also like to introduce, we're blessed to have with us today to comment on Professor Rose's paper, Professor David Larcker from Stanford University. Professor Larcker is the James Irvin Miller Emeritus Professor of Accounting at the Stanford Graduate School of Business. And Professor Larcker was the lead author in a report we published just under 3 years ago with himself, as well as his colleague Brian Tayan and myself, on the question of proxy advisory firms. He's one of the leading experts in this area of policy and regulation. So it's our pleasure to have you with us, Professor Larcker. But first, I want to turn to Professor Rose and sort of set the background here, what we're talking about. And the Manhattan Institute has been looking at this area of policy for about a decade through our Proxy Monitor project. Folks can go to proxymonitor.org and see our online publicly available database of shareholder proposals and certain other matters that shareholders vote on at our large publicly traded corporations. And of course, the proxy process, these proxy statements you get in the mail still, or you might get electronically now, if you're an investor directly in securities that are publicly traded. The proxy process comes through these proxy statements, and most investors vote via proxy. So first, I want just to explain a little bit about this area of law. Professor Rose, tell us, what are we talking about when we're talking about the proxy season? What are we talking about when we're talking about proxy voting, and particularly what are we talking about when we're talking about proxy advisory firms and how they work with institutional investors in this area?
Yeah, thanks, Jim. So great to be here with you all. So proxy season, we are in the midst of proxy season. And basically what that means is that at the end of the year, we have annual reports that are being produced. We have directors that are going to be going up for a vote. We may have other matters that either management or shareholders may want to put up for a vote. And so what happens is that in anticipation of that annual meeting of the shareholders, there will be a proxy statement that Jim mentioned a minute ago that will be created. And at the end of that proxy statement, there'll actually be a ballot that you can fill out and send in, and then somebody will at the company vote on your behalf. So you don't actually have to show up to the meetings as a shareholder. You just fill out that ballot. So when we talk about the proxy season, really just think it's the shareholder voting season. And what we have with proxy voting, you can imagine that there are thousands of publicly traded companies out there. There are thousands of institutional investors that are managing money on behalf of a bunch of retail investors. And so all of these institutional investors have hundreds or maybe even thousands of proxy statements, these large documents that companies are producing every year. They could be 100, 150, 200 pages long. And so to actually go through all those would be a massive undertaking, particularly since many of the votes really are sort of concentrated in this part of the year, because you finish up at the end of the year, you get all the financials for that year, you talk about that, you talk about what's up for shareholder vote, and you give the company time to produce that information, get it out to shareholders. And so for companies that end their year with the calendar year, their fiscal year ends with the calendar year, then you have this mass of proxy statements that are there to be read by investors. So that's really where these proxy advisors come in. What they do is they essentially will help investors by reading through all of those proxy statements and providing advice on how investors can vote on those proxy statements. And of course, I say help, but also, effectively what they're doing, the institutional investors, is outsourcing a lot of the decision making about that vote to those proxy advisors, depending on really how they use those proxy advisors. And there are lots of different ways that they're used. I really am focused, as we'll talk about during our time together today, on a particular kind of use that I see as particularly problematic.
Great. So David, I'm going to turn to you quickly before we go into Paul's specific findings, because we wrote on this a little under 3 years ago, as I said, and so just to be clear, I mean, these proxy advisory firms, and they're really two: Institutional Shareholder Services, ISS, and Glass Lewis, that dominate this market. Work with a broad host of the institutional investors. So if you and I hold stocks, securities, we're not working with these proxy advisory firms, but the institutional investors who hold the aggregated capital and are, the vast majority of capital in the market now is held by these institutional investors. And certainly when it comes to proxy voting, institutional investors play an outsized role. These proxy advisors are sort of the intermediaries between these institutional investors, where our pension dollars or mutual fund dollars are, and how they communicate and vote with these publicly traded shareholder corporations. So Paul, tell us a little bit more about this market, and what we found a few years ago were some of the problems that have been identified in the academic literature, and looking empirically at how these proxy advisory firms actually work in practice.
Yeah, thanks. Yes, it's great to be here with you and Paul today. So we did a pretty comprehensive report, and both legally and economically, about proxy advisory industry, and we've worked on this for many years. Paul did a good job laying it out. The proxies come in a mass. The institutional investors have a fiduciary responsibility to vote on these issues, and then the consideration that they have is, how do they get the votes pulled together in a sensible way? Because ultimately these votes have some impact on the governance that the companies institute. So and so a lot of them use the proxy advisory industry to help them. The real issue is not that the proxy advisory industry exists. It's really, are they expert in making these opinions? And that's kind of what we talked about. How important are they? Do they get it right in terms of, should you vote for this director, or should you vote for or against staggered boards and things like that? So we took a close look at that, I think in a pretty agnostic way, and sort of said, here's the reason they exist. What do they do? How much input do they have in terms of voting? But also, are they getting it right? And I think there's just not that much evidence that they get it right. But that's the source of the controversy. So that's basically our study. And I think what Paul's looking at here, the robo-voting, is a very problematic aspect to proxy voting. So let me leave it at that.
So let's go back to Paul then, and talk about what really you studied. And you studied this previously. The SEC was engaged in rulemaking, formally launched with a proposed rule in November of 2019, and then last summer finalized with a final rule on this question of proxy advisory firms. A specific rule was promulgated. You informed the SEC with some of your prior work, and this is sort of an extension of that work, looking at this phenomenon of what's called robo-voting. So what do we mean when we talk about robo-voting, Professor Rose, and then how are you specifically studying this?
Yeah, so robo-voting, and you can actually see this discussed by the SEC in some of its proposed rulemaking, really comes in a couple of forms. One way that robo-voting exists is that you can have a proxy advisor basically pre-populate your votes for you. So it's almost like you get a ballot that's filled out, in a political election. You just show up and you can accept the ballot as it is and cast the ballot, or maybe you can go in and change some things. So some institutional investors will actually just have votes pre-populated, and then will decide whether or not they want to use those pre-populated votes. Other institutional investors will actually just wholly give to a proxy advisor the ability to make those selections. They will say that, they largely agree perhaps with what the proxy advisor's take is on corporate governance structures, and then just allow the proxy advisor's recommendations to be voted accordingly. So both of those kinds of activities are things that we would term robo-voting. Now, in my research, and I'm not the only person that's looked at this issue, there was a nice piece by a friend of mine that was working with ACCF that looked at how prevalent robo-voting was. And in that study, they thought, well, if you're voting in line 95% of the time with a proxy advisor, that kind of looks like robo-voting, because you're basically just giving them authority to vote and maybe changing a very small number of things, if you're changing anything at all. In my research, and I've done a couple of studies now, this is the second, really looks at an even higher threshold, where I've really looked at sticking with a proxy advisor 99.5% of the time. So a really high level of consistency. And that's really what I've called robo-voting. I mean, at least that's the evidence that we can see of how prevalent this activity is. Some institutional investors will provide disclosure about how they're using proxy advisors, and they'll say that they essentially do adopt whatever the proxy advisor says, but many frankly do not. And to kind of go back to David's point, that's really part of the concern, is that we have these corporate governance decisions being made by proxy advisors. We have institutional investors accepting those and ceding the authority to vote in accordance with whatever those preferences are. But first of all, it's not always clear whether what they're considering to be the appropriate sort of corporate governance structures are really the right ones. And certainly company by company, we may have doubts that a one-size-fits-all kind of policy would be appropriate. But also just in terms of the fiduciary duty aspect of making sure that you're voting consistently with how your beneficial owners, the retail investors that are giving you money as an institutional investor. I mean, that's the problem that I'm really trying to highlight and focus on in this paper. Do we see institutional investors essentially allowing the proxy advisory firms to decide for them on important corporate governance matters without much or any thought given to the actual questions that are before the shareholders on a given company's proxy statement?
Yeah, I mean, that's really the question here, and we got an audience question, a couple already in. I'll ask one of them because I think it sort of flows here. We'll go to the audience more later, but one of the audience members asked, I think in response to something Professor Larcker was talking about, is whether the proxy advisory firms get it right. Asked, how do we define right when a decision to vote is a point of view based on a variety of beliefs? And that's an interesting question, and it's something that Professor Larkin and Taya and myself wrote about in our paper. There's a number of sort of empirical studies that have been done. You can sort of track things like share value on this, on certain of these questions. But one thing that we looked at, and we did an empirical study of this with my colleagues Peg O'Keefe and Evgeny Feynman back in 2012, and looked at ISS recommendations in voting. And what we found was it was a significant misalignment. So in other words, ISS was making recommendations that were fairly deep in the minority to some degree. I mean, they weren't the bottom minority. These weren't the shareholder proposals that were getting single-digit support, and that somewhat would be impossible given the way the proxy advisory firms influence the vote itself. But they were in tension with what the vast bulk of institutional investing capital was doing in terms of shareholder voting. Now, that doesn't mean that BlackRock and Fidelity and State Street and Vanguard and these other big institutional investors are always getting these questions right. We don't know that for sure, but it is indicative of the fact that when they're doing their independent analysis and coming up with their independent voting recommendations, there's a departure in what they're doing and what ISS was doing. And in fact, there's some recent empirical evidence that Professor Rose talked about in his op-ed that was published today in National Review Capital Matters, and we'll link to that later in the chat box. And it talked about in the report, but there was some recent research within the last year that suggested, in fact, some of how that happens. In other words, why the proxy advisory firms might be subject to capture by some of these investors that have interests other than mere share value maximization, and what some of the financial implications of that could be, which sort of, I think, sets the context for why this robo-voting is important, we believe. So you want to talk about that a little bit, Professor Rose?
Well, yeah, I mean, I have, I guess I have pretty strong feelings about that. I mean, I definitely feel like, we can certainly look at things like shareholder value as a kind of metric, right? And we can say, well, do proxy recommendations tend to link to shareholder value? But I guess the point from that study that you just referred to that's really interesting to me is that if you think about these firms as a business, right? Proxy advisors are a business. They're a for-profit business, right? They're not doing this as a nonprofit. This is a for-profit entity that's trying to fight for market share. ISS dominates that market, as you mentioned before, and something like maybe 86% and maybe 14% for Glass Lewis, another competitor, but they're fighting for market share or trying to retain that position that they have. And so, where are they going to move their advice to try to capture institutional investor dollars and try to make, at least respond to what institutional investors as the buyers of that advice might want? And what's interesting about that study is it seems like there are quite loud voices, maybe in what you might call sort of the ESG space, that are non-wealth maximizing, that are actually garnering a lot of attention from the proxy advisors, meaning that they're shifting the advice to try to go to those, to the interests of those particular institutional investors. So I find that pretty fascinating and a really important study that I think really informs what I'm thinking of with the way that robo-voting takes place.
Yeah, I think that's right. And it's sort of what we've always hypothesized. I've submitted comments to ISS in their sort of annual review of their proxy policies. And of course, I'm just some guy. They're not going to listen to me, but they are going to listen to some of their institutional investors that actually pay them fees. And of course, if the big institutional investing fund families have the economies of scale such that it makes sense for them to have their own corporate governance teams deciding how they vote, and they may be getting some of these wrong too, but deciding how they vote on all these questions, the exact policy recommendations that ISS is making aren't going to be particularly important to them. But these institutional investors that have these sort of very strongly felt social and policy agendas may lean quite hard on ISS to sort of say, to go along with their viewpoints. And that's in fact what this paper that John Matsusaka and Chong Xu at University of Southern California published just last year found. And so that paper, as well as another paper by Xu, is linked in the report. But they found that the proxy advisory firms tend to, quote, tilt their advice away from policies that maximize issuer value toward policies that give more weight to social issues. So, and of course, the mechanism there, why these institutional investors that are oriented towards these social policies, which could include, of course, public employee pension funds who are often controlled by political actors with political agendas, the reason why they care is precisely because of this phenomenon of robo-voting, where institutional investors aren't, in fact, exercising independent fiduciary judgment on all these questions, but are merely following the voting advice of the proxy advisory firm itself. So let's turn to the empirical findings that you have, Professor Rose, in your report. What did you find previously in your previous work that you submitted to the SEC in comments about the phenomenon of robo-voting and how significant it is? And then what, if any, change did we find last year in the proxy season? I want to emphasize that last year there was not a new the new rule wasn't in place. The preliminary rule had been introduced. The rulemaking was underway. And so institutional investors who are, of course, forward-looking could anticipate the rulemaking that was coming to some degree and might have been changing their behaviors, but it wasn't, in fact, set in stone at that point. And in fact, it's not going to be operative upon the players in this market until the end of this year. So this proxy season as well, it won't be a mandatory rule that institutional investors and proxy advisors are subject to, but they're going to know what the rule is, so they'll be preparing for that reality. So what were the empirical findings that you found, Professor Rose?
Yeah, so I'll talk first about the other piece that you mentioned, which I'd submitted in a comment letter to the SEC, and that piece really just looked at the prevalence of robo-voting. Again, this was under the old rules, and there really wasn't even the framework yet when we were looking at this data that suggested how robo-voting could possibly be regulated in the future. But in any event, again, I mentioned that I wanted to take a pretty high threshold on what I considered to be robo-voting. So not merely just voting with them 95% of the time, but 99.5% of the time. And so we had some data that we were able to get from Proxy Insight, and we were looking at the total number of investors that were aligning with ISS, and it was nearly 100 that did back in this prior paper, and assets under management of more than 3 trillion. So we're talking some serious money here. And then what I wanted to do, as you said, was really look at how things may have changed given the SEC's rulemaking. Now, just as a little bit of background to that, not too much in the weeds, but as a little bit of background, the SEC had thought about imposing some pretty strict rules that actually might have prohibited robo-voting. When they came out with their proposed rules, they entertained the idea that, maybe we just wouldn't let you pre-populate vote cards. Maybe we wouldn't let you engage in automated voting. You actually had to review everything, and maybe the proxy advisor could advise you, but they couldn't actually file this stuff on your behalf or give you a voting card already filled out, essentially. They backed away from that. They essentially took this kind of principles-based approach where they really wanted to encourage both companies and institutional investors and proxy advisors all to provide more disclosure about how they are engaged in this sort of market for proxy votes, if you will. And so it's on that basis of knowing that the SEC wasn't going to prohibit robo-voting, but was going to at least encourage proxy advisors and institutional investors to be quite deliberate, especially institutional investors, to be more deliberate in the way that they disclose their use of proxy advisors. We really wanted to look to see whether that would change behavior and whether you'd see less robo-voting after that rulemaking came out. Again, as you said, it isn't in place until 2022. So this proxy season, last proxy season, which is the subject of this report, we shouldn't expect to see a dramatic change, but maybe we see some institutional investors moving towards, or I should say maybe moving away from robo-voting and maybe more disclosure from those institutional investors. Now, what we ended up finding is that there's still quite a use of proxy advisors in a kind of robo-voting way. Again, ISS is dominant in this space. Using that benchmark of 99.5%, we found 114 institutional investors vote at or above that threshold, meaning that they're lockstep with ISS or Glass Lewis on 99.5% of the matters up for vote. If you look at the total assets under management of that group, it's about $5 trillion assets under management. So again, a really big number. And in terms of just how things changed, we did see a slight downtick in robo-voting and the number of institutions that are robo-voting and in the assets under management by robo-voting institutions, there's a little bit of a downtick. And so it'll be interesting to see what happens this proxy season. As you said, here we are a little bit closer to this time when there's going to be, we would hope, more disclosure about how institutional investors are outsourcing their voting decision making. And so maybe that would create an incentive for institutional investors to move away from a kind of robo-voting regime. We'll stay tuned, right? And we're going to take a look at this again for this proxy season and look to see if that small trend that we saw this year continues.
And just to give our listeners a idea of the size of this picture we're talking about like 3 to 5% decrease, depending on whether you're looking at the number of institutions or the number of matters voted upon or upon assets under management. 3 to 5% drop year over year in measured robo-voting. So there has been an impact of the SEC rulemaking, assuming that's causal, and of course it may not be. But there certainly has been a slight change, but it's still relatively at the margin. Let's move a little more to this disclosure, because this was a part of the sort of principle-based rulemaking that the SEC did. And what did you find in terms of disclosure? Did you see much change in what was going on in terms of disclosure policies? And did you see institutions that were shifting what they were doing in a positive direction, or frankly the inverse, or not making much difference?
Well, I guess I would say that there's not a huge difference for me in terms of what the disclosure looks like. I think that there's some firms took the initiative to change their policies and say, look, we're based on the new rules, we know that we need to provide a little bit more disclosure about conflicts of interest, about how we use proxy advisors, and so they did that. But my sense is, from what we were able to gather so far, that there hasn't been a big shift. I would think that this is really the time that we will see that shift. So I'm going to be really curious. Now, that's a more difficult undertaking in terms of data gathering. And, if you're looking at thousands of disclosures, that is going to be problematic. But you can narrow that down a little bit and say, well, let's just look at the disclosures by habitual robo-voters and see if those have changed. And that's really what we're going to do, along with just looking at the effects of this rule on robo-voting in the next report.
Now, you also, first of all, just to clarify on the disclosure, I mean, the idea here, I think, is just to make sure that folks know what their institutional investors doing. I mean, at the end of the day, the institutional investors are holding money effectively in trust for those of us who have money with them. And so it's to make things very clear what they're doing. But one thing they could do, right, is just say, yeah, we're going to robo-vote with ISS. Could they do that under the SEC rule?
Yeah, I think they could. And I mean, if they really believe that the kind of policies that ISS has, and I don't think the SEC is going to spend a lot of time trying to look into their heart of hearts to ascertain that. But, they could say, well, we do use ISS for robo-voting. And if you look at ISS's policies, there is a general logic to their policies, right? I mean, I think that I would characterize much of what ISS tries to do, and Glass Lewis for that matter, as kind of shareholder empowerment, which makes sense if you're thinking about this as a business who's trying to appeal to institutional investors. Hey, institutional investors may like the idea of more accountability for managers. So if you can push for corporate governance changes that would tend to promote more accountability, meaning that you get rid of, say, staggered boards of directors, to moving to annually elected boards of directors, or you institute majority voting policies or things like that they think will increase accountability, I could see an institutional investor taking that position and saying, to that extent, we like the direction that they're going. And so everything they're doing is fine with us. Now, that's the thing about disclosure, though, right? I mean, since we have a disclosure-based regime, disclosure doesn't mean that the retail investors are going to leave in flocks if they perceive that robo-voting is going on. And I think we have to be realistic about that. I may personally wish that they would pressure their institutional investors more on that issue. But there's another problem that we really haven't talked about, that you and I have talked about in the past, Jim, which is that, for some of these institutional investors, it's actually really not built into their structure. They're very, what you might call sort of cheap intermediaries. They're trying to give access to a market as cheaply as possible. And so they may not want to invest in corporate governance. And so they may just use robo-voters, not because they care about the issues that ISS seems to care about, but simply because they just don't have it in their budgets at a kind of fee for assets under management to expend resources on corporate governance. I mean, that's another reality, I think, that is sort of behind what we're talking about here, and that sort of tempers my my expectations a little bit for big changes. I would like to see change by institutional investors and focusing more on disclosure, but I also recognize that it's probably not likely to create a stampede of retail investors out of those products if they perceive robo-voting, because I think that they're just not going to be reading a lot of those disclosures. Some will, but some won't. But that's one of the reasons why I think having discussions like this is important, actually, because then it sort of highlights this question and maybe puts it in the minds of people in a way that just, if there's disclosure out there and you don't hear about it, you're never going to read it, right? So at least this is getting the issue front and center so that we can talk about it.
That's like, how much do the individual investors typically read their full proxy statements either? I mean, a lot of this disclosure regime, and our securities laws are predicated upon a disclosure regime. And effectively, the notion there, I think, while it's geared towards empowering the individual investor, it really puts a lot of information there, so the activist hedge fund type investors will pour over these statements and look for anything they can to have an edge, and it'll keep the market relatively efficiently priced, which means that, barring exceptional events, and of course they've happened in the market, but barring these exceptional events, the average institutional investor is somewhat protected, even though the average individual investor is not doing this sort of research on his or her own. And so, I mean, I'm part of the problem here is just the simple voting dynamics. And any of us who've studied public choice theory know that voters are quite rationally ignorant in ordinary political markets, right? I mean, my law school classmate Ilya Soman has written a book on this. His George Mason economics colleague Brian Kaplan, slightly different book, but looking at this phenomenon, voter ignorance on political questions is quite broad, and people effectively delegate their votes, often to the major political parties, which sort of take a broad platform and they sort of can choose, and most people can sort of choose one side or the other on that. And the political ignorance is sufficiently significant. I went to vote this last fall, and the board of the school board, the education board folks were up for election. It was a nonpartisan slate. I mean, I'd actually done the research and decided who I wanted to vote, but most people aren't going to do that. Particularly people like me. If you don't have kids in the public school system, then you don't even have much interest on it. They don't have tax policy or what have you. So the political parties are out there handing out papers to people as close to the polling sites as they can to try to say, vote for this slate of candidates because it's nonpartisan. But people really haven't done the research. I mean, so this is true in our ordinary elections as well. And it's certainly true for an institutional investor that's fighting with tight margins, intense competition, and these smaller funds that just don't have the economies of scale to invest in this. They're not going to attract new dollars by saying we're the best voter on proxy matters for questions where we own a tiny fraction of a percent of the company, and our vote's not going to be outcome determinative in any event. So that's why these proxy advisory firms have such disproportionate power to begin with. Let's pull Professor Larcker back in, because I want to sort of get his commentary on the paper and what Paul found and what the sort of implications are from your point of view.
No, I thought the paper is great. I mean, one thing about research in governance is there's a lot of opinions, not much facts. And I think this is more fact-based, or I guess the new terminology would be evidence-based. So I liked it a lot. And I think that the thing that we really need to highlight here is the robo-voting has a very specific outcome. It gives a lot of power to an outside entity that is hard to evaluate whether they're doing the right thing or not. And so one thing that we've been pushing is, if the funds don't want to vote their shares or are not going to do the analysis, why force them to vote? If you took the votes away, if they didn't put their votes in, the influence of ISS and Glass Lewis would become de minimis at that point. And again, Glass Lewis and ISS may be doing the right thing, but as far as I know, there's really no research that they've done to confirm this. And governance is very contextual. I mean, Paul brought up staggered boards, which has been a very contentious issue. There's a lot of evidence to suggest that sometimes staggered boards are good. Sometimes they're not good, but it's a contextual type of thing. That makes the analysis of what's right or wrong pretty hard to do. And whether the proxy advisory firms do this or not, I'm not so sure. The other thing I think is important, again, it's not meant to be a criticism of Paul's work. It's hard to measure robo-voting. I mean, you could pull up the voting documents of mutual funds or institutional investors. Some of them will say, we outsource the whole thing. We don't have the ability, the capacity, the cash flow to do this. We have to vote to satisfy a fiduciary role, but we're not going to spend a lot of time on it. Again, I don't think that's a good idea. On the other hand, if you sort of say, look, well, you don't have to vote, then you're basically having a free rider problem where you're piggybacking on BlackRock and State Street, Fidelity, Capital Group, the big funds that are doing this. But they do devote resources and they have an opinion about it. They're just not, outsourcing or, robo-voting. So I think this is very, very important. And, I think we all know that, contested votes where management and ISS, disagree, we're probably talking 20-30% swing in the votes. And that's what the paper that Jim and I did with Brian Tayan sort of found out. Well, that's a lot, right? The other thing about robo-voting, and again, maybe just a small refinement, some of the votes are just perfunctory. We're going to ratify the auditor. Okay, we all voted for the auditor, but the more interesting things are when you have controversy among the board members, where you have an equity plan that's up for renewal or increasing and things like that. So I mean, there's some refinement that goes on, but it's tricky. But I've talked to many governance heads in institutional investors. They say, look, we don't have it in our disclosure that we're robo-voting, but with rare exception, we're just going along. And the other thing, and I know Paul's aware of this, that if you look when ISS issues their report on the company, there's a huge influx of votes that are tabulated for that company within minutes or hours. I mean, clearly, if you could get access to this data, I mean, there's been no analysis that's been done. So a real hard estimate might be, kind of looking at this, but that's hard data to get. And let me just I want to get back to Paul, but one study we've been thinking about doing is you can look at individual companies, like what share of their votes are actually robo-voted. For some companies, it might be a few percent. Other companies, it might be 50, 60%. Well, those latter set of companies, that's where ISS and Glass Lewis are going to have a big impact on the governance structure of that company. And one thing you could do is sort of say, do those companies perform more poorly because they've been forced into this box by just the nature of the shareholders that hold them. Now, of course, they're going to be smaller sorts of companies, but there's ways to get a handle on this. It's just hard to do. And I think Paul in his work has taken a really important first step, saying, let's open this box up.
Jim, if I could comment really quick on one of the really important things that David said just there, because I don't want it to be lost on our audience. This whole industry didn't just spring out of thin air. I mean, this was a creation really through regulation. I mean, what happened is that you had federal agencies essentially saying that you have a fiduciary duty, if you're managing other people's money, to vote these proxies in the best interests of your shareholders. And so what that does, as David said, is it creates this industry as a result of that fiduciary duty that responds to the real practical problem of having to go and read through thousands and thousands of pages of documents in this really short window when you don't have the staff to do it. And a quite sensible way of thinking about that problem might be just to say, as David did, why do we have that rule? I mean, why do we need to have every institutional investor vote each of these proxies? Maybe we should think a little harder about that question, right? But however you come out on that issue, I think it's important to recognize that this whole industry was really created through that regulation that was really trying to put fiduciary duties on these institutional investors, and that fiduciary duty created this necessity to hire folks to help them with it.
Yeah, the other thing I think is important is I think most institutional money managers don't use the ISS scores for anything. They're not using that for investment. If they're going to do governance, they're going to have their own screens in selecting. And the problem is, in my mind, and certainly this is controversial and worthy of debate, what's the corrective mechanism if ISS and Glass Lewis get it wrong? Well, if you're not really using it for anything, your job, investment, and you get it wrong, so what? I mean, you don't stop purchasing this because you're trying to use the mechanism to satisfy your fiduciary role. You're not using it for, real investment. And so I just don't, it's a very, and Paul's absolutely right. The combination of having to vote your shares and the MPX requirements and other kinds of things, it's generated this industry, and it may be fine, but I think we need to take a deeper look at the impact of it, and is it value accretive or not? As we move maybe from a straight shareholder economy or shareholder-centric view to a stakeholder view, then they're going to be weighing in on ESG or cyber and all these kind of things. I mean, do they have the expertise to do that? And does it make sense to, to follow these votes? So again, I don't know, but there's some interesting research that could be done, and it's hard to do without help from the proxy advisory industry or the SEC or people like that.
Yeah, so we're starting to get some audience questions. I want audience members to know you can type it into the box, and our team will try to get them in front of me. I may not be able to get to all of them, but we've got some good questions that are coming in on that. But I think you're absolutely right on that. And Professor Rose, this is an industry that existed in some form before the late 80s, when the Department of Labor created the clear fiduciary rule in a letter for pensions, and then in the early part of this century, the SEC followed suit for the broader set of institutional investors. But one question I've always had on this: why would you not have an institutional investor that didn't want to invest in this take exactly the opposite tack, rather than say, I'm just going to follow the proxy advisor's recommendation, say, I'm long the company, so I'm going to follow the board's advice. I have confidence in the company, that's why I invest in it. If there's a contested takeover situation, I'll look at it. Otherwise, I'm confident in the company, that's why I bought the stock. And for most institutional investors that aren't activist investors trying to shake up the boards and managements, that seems like a strategy that would be quite rational. And they may still want to pay for a report from ISS in case there's a contested situation. But in the vast majority of cases, why wouldn't an institutional investor do that strategy?
Do you want to take that, David, or should I? I mean,
No,
think
it's your show, Paul.
Sure.
Yeah.
Well, I mean, I think that historically a lot of them did, right? And voting just right down the management slate and voting however management thought you should vote was what a lot of institutional investors decided to do. I don't know. I mean, as an academic, I guess I think of this as, I situate this sort of historically as part of a part of the shareholder empowerment movement, and this idea that really started in the 70s with the idea of our managers and our directors as agents, and wanting those agents to act in the best interests of the shareholders who are the principals, and so you really saw this push for mechanisms that would almost push back against management and try to make management more accountable. And that was really the buzzword in corporate governance for decades now. And I think that that has had a lot of salience, that idea. And I do think that there are some institutional investors who might take exactly the position that you're talking about, Jim. But now, of course, you do have this kind of good governance industry that is saying, look, we need them to be accountable. We need them to, act in your interests. I should note, though, as an aside, that as we move into an era where we have more concerns about ESG, that view is going to have more tension in it, because if the end result was accountability and shareholder wealth maximization and making sure that there wasn't rent seeking by managers or whatever you want to call it, well, how does ESG fit into all that if that's really what managers are supposed to do? So,
yeah. So, and what we're talking about when we say ESG, it's environmental, social, and governance, right? It's sort of an acronym. I never liked the acronym just because I think governance questions, staggering boards and things like that, are quite different from environmental and social issues, which while they may have a relationship to share value, they're not at the core of why we have shareholder voting rights to hold board members accountable. Whereas if you're talking about how you elect directors or how often you elect directors, that's sort of the core shareholder voting rights question. One thing I've emphasized in congressional testimony and elsewhere is the notion that, yes, we have agency costs that are real, the sort of costs of management for shareholders that have put their money out there. How do you get managers not to run away with your money or blow your money or spend it on their own perks or whatever else, which is sort of the classic underpinning of our whole corporate law regime and corporate governance regime. But there are also these agency costs for these institutional investors, right? If you're a big hedge fund and you've got your net worth tied up in your fund and you're taking giant bets and you're getting 20% of the profits you make on your fund on an annual basis above a high watermark, you have an enormous incentive to try to get it right. And so you don't really have the classic agency costs for these types of hedge funds. But for these dispersed institutional investors, they have the same sorts of agency costs themselves. And so one of the questions we got from an audience member here, I think is a good one, do you see an issue with institutional investors like BlackRock, whose CEO, Larry Fink? BlackRock's the largest manager of assets, the largest institutional investor in the world. But do you see an issue that companies like BlackRock seem to be putting their ESG models in front of what we might argue would be with their median shareholders' financial interest as an investor? And how do we think about that? How do we think about those level of agency costs? Because ISS is one thing, and again, this is a little bit afield from the Robovoting and ISS question. So I'll open it up to either of you, because it's really a question about institutional investors more broadly.
Yeah. So it's this is going to be the grand debate over the next pick out some decades. I mean, clearly the U.S. is more shareholder centric. Paul's more familiar with the legal issues of this, but it's still being debated as I understand it in the legal literature. But I actually wonder about the fiduciary responsibility. I mean, I think fund managers have a strict fiduciary responsibility to do things in the interest of shareholders, to increase shareholder value. And so unless you've polled all your shareholders and said, are you okay if we go down the ESG path? and it may not be accretive for shareholders. I'm not sure how that plays in the broader scheme of things. Now, some people, I think their argument is basically ESG is just the right thing to do, and it may be true, and it goes hand in hand with shareholder value. I'm not so sure about that, and so it's an interesting decision to make, saying we're going to go whole into ESG. If it's detrimental to shareholder value, I think there's a lot of certainly interesting economic and certainly legal questions that come about. But this is going to be the grand debate going forward.
Yeah, it is a fascinating question. And, if you think about BlackRock, right? I mean, one argument that I've seen is that, well, BlackRock's competing for, say, the millennial dollars that care more about these issues, right? So maybe they are actually trying as an asset manager strategy to acquire dollars by taking these ESG positions. But then, of course, BlackRock is also going to be the selected asset manager for folks who have no other choice. Their company might use BlackRock exclusively, and they're just going to be stuck in a BlackRock fund and maybe have little say in how BlackRock uses their money. So that is an interesting problem. I feel like for some issues, there is a good argument to be made that certainly some long-term risks related to sustainability, let's say, do have financial implications. But like David, I'm agnostic about, I will certainly admit that, but I also want to see data driving some of that decision making. Otherwise, for me, a lot of that work I feel is, frankly, this is my position, a government function, and I feel like it's especially when you're in a democracy, you actually want to debate and talk about these issues, and so I want to see it carried out in that sphere rather than in a way that, frankly, creates agency costs, just like you're talking about, Jim, because that's really what I see those decisions as being. Again, it's not the agency costs that we were concerned about 30 years ago with the CEO maybe taking liberties and not doing a great job and hiring friends and providing high levels of compensation to directors that keep them in power or whatever. While we still may have those agency costs to worry about, we also have institutional investor agency costs where we're worried about how those agents that are managing our money are managing our money and the kinds of things that they're doing as asset managers. So, we haven't ever gotten away from those agency issues. Now we just have another layer of them.
Yeah, and it's I just wrote a book on it. It's behind me, above my head, The Unelected, really talking about how all these different levers are making decisions that affect broad social and policy goals for us in society without going through our sort of constitutionally prescribed electoral process. And I think this is just one more tool in the toolkit alongside many others. But it's a powerful tool because these big multinational corporations do have a lot of power. The important questions about how to tax and regulate them are very, very important. But I'm not sure it should be done by sort of a small set of social activists who figured out how to game the system. And it's a system that's, created in large part by the Securities and Exchange Commission, which is, of course, a staggered independent agency appointed by the president and confirmed by the Senate, but a couple steps removed from the sort of public elections we have. And then you're removing it yet further when you have these big institutional investors. We got one more question in here that I think is worth our talking about, and that is from one of our audience members who talked about the recent ownership change in ISS, and in fact we had ownership change in Glass Lewis as well. Is there any hope that there might be a change in or a moderation of these proxy advisors' ideological biases or conflicts of interest or anything based on a change in ownership? I've got my opinion on it, but I'll let you guys talk about it first.
I can take a first stab, I guess. I look, I think of ISS and Glass Lewis as businesses, right? And I think that they're trying to capture market share. They're competing with one another. There are some other smaller players in the industry that try to compete on advice quality. They don't seem to be making any headway. Maybe that's because ISS just provides, as one of my friends has called it, sort of criticism insurance, and that's really their role. So, I guess I'm a little bit skeptical that they will change their behavior under new management. I mean, possibly, and maybe there are issues at play. I think with Glass Lewis being owned by an Ontario pension fund, I could see that as creating more of a move towards maybe ESG issues, just in terms of their own alignment, because they were very vocal about how they felt about those questions. But now owned by a private equity fund, does it change things? I don't know. I guess count me a skeptic on that. That we'll see a lot of shift, but I'm not sure.
Yeah. So as you know, the ownership history of both is complicated, and again, I think one thing to point out here is I think the idea of having proxy advisory firms is not bad. No. Companies use auditors, they use consultants, et cetera, and the problem is here you have a classic duopoly, right? And one's a lot bigger than the other, and the smaller one is going to have more radical views to maintain, their economic viability. But I think the problem is there's no competition, right? And so the problem is the fixed cost to actually come up with a new proxy advisory company that spans, thousands of companies around the world is enormous. And then, the fees, who knows, but, they're probably solid, but not, it's not like investment banking or something like that. And so it's an industry that I think just needs to be a little more open, try to do some real research, and, try to get it right. But it's costly to do that. And so they have kind of a, not necessarily a complete one size fits all, but they have to minimize their costs of doing this and making these recommendations. And so they're in a kind of a tough position as well. I believe that from the newspaper reports, the acquisition of ISS seemed to be due to their ESG data, and that's bound to be a growth area. We should have another show like this on ESG and the measures and the consulting feeding frenzy that's going on, and whether we have it nailed down or not. So, but that's another issue.
Yeah, I agree with both professors on this. I don't think the ownership change is going to make a huge difference on it. We've seen them passed around. ISS has been passed around a few times, various private equity firms. They were owned by MSCI for a while, which is a subsidiary of Morgan Stanley, a publicly traded company, which gave me a lot of insight and data because they were broken out in the actual proxy statements of their parent company, and so we could see what was going on. First of all, it was interesting that ISS had a number of sort of standard governance recommendations on various shareholder proposals and governance items that were in complete conflict with what their parent company actually had in practice, which I found quite interesting.
Well, they were public at one point as well, right?
Yeah, exactly. Well, they were a subsidiary of MSCI, wholly owned by MSCI. So we also got to know what their numbers looked like. And at the time, and this was a handful of years ago, but you had a business that was generating revenues of 110, 120 million a year level, and profits on their advisory business, pure play, not just consulting with the companies, of something like 10 million a year, which tells you why, to some degree, it's a duopoly, and why there's not a lot of new entrants springing up. There's just not a lot of money on the table for this, in part because I do think institutional investors view it as just a relatively inexpensive way to get other information sources for the big institutional players, the BlackRocks and Vanguards of the world, or as a cheap way to discharge their fiduciary duties. And so they don't make a lot of money on this, but they have enormous influence over the voting. I mean, some of our empirical evidence suggested 15+% of the final votes on institutional shareholder proposal type questions were influenced directly, almost entirely by ISS. So it's acting like it owns, 10–20% of the total stock market in terms of its influence over voting structures, which is why this is an important question. It's why robo-voting matters, because we've got this small company with fewer than 1,000 employees, last I checked, in Rockville, Maryland, making all these decisions on a relatively bare bones budget, given the enormous scope of influence it has. $5 trillion by Paul's recent count last year in the financial markets via robo-voting. So a very important policy question, something obviously that our Securities and Exchange Commission has been paying attention to. We are at the end of our time, so I do want to thank both our guests, Professor Rose and Professor Larcker, for joining us. Professor Rose, kudos on an outstanding paper. Thanks to all our guests who have joined us today. Viewers who want to read Paul's full paper, look in the box on the screen. It'll be linked there, as well as his op-ed in National Review Capital Matters just this morning, discussing the paper in a more abridged form and the policy implication there. Viewers interested in learning more about the Manhattan Institute and our Proxy Monitor project can subscribe at our newsletter and follow the Proxy Monitor project in the link that's also going to be provided on your screen. So thank you, guests, and thank you, Professor Rose and Professor Larcker, for being with us today. This is Jim Copland on behalf of the Manhattan Institute.